In September 2018, a German technology company named Wirecard achieved something extraordinary. It joined the DAX, Germany's prestigious index of leading public companies. Wirecard was presented as the future of European finance, a fast-growing payment processor capable of competing with the biggest companies in the industry. At its peak, the company was valued at approximately $28 billion. But less than 2 years after entering the DAX, Wirecard admitted that $1.9 billion shown on its balance sheet probably never existed. Its chief executive resigned, its chief operating officer disappeared, and the company collapsed into insolvency, owing creditors billions. This is the story of Wirecard, a company that became a symbol of European technological ambition before becoming one of the largest accounting scandals in modern history. Part 1. The FinTech Success Story. Wirecard began operating during the early growth of internet commerce. Its business appeared simple. When customers purchased something using a credit card, Wirecard helped move the payment between the customer, the merchant, and the financial institutions involved. As online shopping expanded, payment processing became an enormously valuable industry. Wirecard positioned itself directly in the middle of that growth. The company provided payment technology, issued cards, and offered banking services through its own banking subsidiary. It expanded internationally and reported rapidly increasing revenue. To investors, Wirecard looked like exactly the kind of company Europe had been waiting for. A homegrown technology champion capable of competing on the global stage. At the center of the company was CEO Markus Braun. Braun promoted Wirecard as an innovative technology business transforming the financial industry. Investors embraced the story. Wirecard's share price rose, its reputation grew, and the company eventually became valuable enough to replace Commerzbank in the DAX. The symbolism was powerful. A traditional bank with a history stretching back to the 19th century was being replaced by a modern financial technology company. To many observers, this looked like the future replacing the past. But behind that image, questions were growing. Part 2. The business nobody could verify. A significant part of Wirecard's reported success came from something called its third-party acquiring business. In countries where Wirecard did not hold the necessary licenses, it claimed to work with outside payment processing partners. These partners supposedly processed transactions for merchants on Wirecard's behalf. Wirecard would then receive a portion of the revenue. There was nothing inherently unusual about using business partners. The problem was that outsiders struggled to verify the activity Wirecard claimed these partners were producing. The company reported large amounts of revenue and profit from operations in distant markets. But journalists, investors, and analysts repeatedly questioned whether those transactions were real. Some of Wirecard's supposedly most profitable activities appeared to leave remarkably little visible evidence. Instead of providing clear answers, Wirecard frequently attacked the people asking questions. Critics were accused of working with short sellers, investors who profit when a company's stock falls. The company insisted that allegations against it were false and misleading. This defense was powerful because Wirecard was no longer viewed as just another company. It had become a source of national pride. Criticism of Wirecard could be portrayed as an attack on Germany's most promising technology success story. Part 3. The warning signs. Questions surrounding Wirecard did not suddenly appear in 2020. Concerns had been raised for years. Financial Times journalists investigated the company's accounting and reported allegations involving suspicious transactions and questionable documentation. Wirecard strongly denied wrongdoing. Instead of focusing only on the company, German authorities also investigated journalists and investors who had raised concerns. In 2019, Germany's financial regulator, BaFin, temporarily prohibited investors from establishing new short positions in Wirecard shares. The ban was intended to protect confidence in the market, but it created an extraordinary situation. The authorities responsible for protecting investors appeared to be defending Wirecard while treating some of its critics as the threat. Wirecard continued to insist that its finances were sound. Its regular auditor, EY, had approved the company's accounts for years. To ordinary investors, this provided reassurance. Wirecard was a major public company. It was audited, it was regulated, and it was included in Germany's most important stock index. How could a company with all those layers of oversight possibly be hiding a massive problem? That assumption would prove disastrous. Part 4. The Special Audit. Under increasing pressure, Wirecard appointed accounting firm KPMG to conduct a special independent audit. The company expected the investigation to clear its name. Instead, the audit created even more questions. In April 2020, KPMG reported that it had been unable to obtain enough documentation to fully verify important parts of Wirecard's third-party business. KPMG also faced difficulty confirming certain cash balances and transaction data. This did not automatically prove that fraud had occurred, but it meant Wirecard could not provide clear evidence supporting some of its most important financial claims. Investors reacted immediately. Wirecard's shares fell sharply. The company continued trying to reassure the market, but time was running out. Its regular auditor, EY, was preparing to approve or reject Wirecard's 2019 financial statements. At the center of that audit was $1.9 billion supposedly held in trustee accounts at banks in the Philippines. That money represented roughly 1/4 of Wirecard's balance sheet. If it existed, the company still had a chance to survive. If it did not, the foundation of Wirecard's financial story would collapse. Part 5. The Money That Never Existed. On June 18, 2020, Wirecard announced that EY could not verify the $1.9 billion. Documents intended to prove the money existed appeared to be false. Wirecard initially described the money as missing, but that language suggested the cash had once been there and had somehow disappeared. 4 days later, the company made a far more devastating admission. Wirecard said there was a prevailing likelihood that the $1.9 billion had never existed. This was not simply an accounting mistake. 1/4 of the company's reported balance sheet may have been imaginary. The reaction was immediate. Wirecard's share price collapsed. Banks faced the possibility that loans made to the company would not be repaid. Customers and business partners began distancing themselves. CEO Markus Braun resigned and was arrested shortly afterward. Prosecutors later charged him with fraud, breach of trust, and accounting manipulation. Braun has denied wrongdoing and maintains that he was deceived by others. Wirecard's chief operating officer, John Marsalek, took a very different path. Marsalek was dismissed from the company and disappeared. He became an international fugitive whose location has remained the subject of continuing investigation and speculation. On June 25, 2020, just 1 week after the missing money was publicly revealed, Wirecard filed for insolvency. It reportedly owed creditors nearly $4 billion. The company that had represented the future of German finance became the first member of the DAX to collapse into insolvency. Part 6. How did everyone miss it? Wirecard's collapse was not caused by a single failure. It was enabled by several failures happening at the same time. First, investors wanted to believe the growth story. Wirecard operated in a fashionable industry and appeared to offer Germany its own global technology champion. Second, much of the company's reported success came from complicated overseas relationships that were difficult to independently verify. Complexity created a place for questionable transactions to hide. Third, Wirecard responded aggressively to criticism. Journalists and investors asking difficult questions were portrayed as enemies attempting to destroy the company for personal profit. Fourth, the auditing process failed to uncover the truth soon enough. For years, investors assumed that Wirecard's approved financial statements meant the company's cash and profits had been properly verified. Finally, regulators focused heavily on defending confidence in Wirecard, rather than thoroughly examining whether its claims were true. Each layer of trust depended on another layer. Investors trusted the auditors. Auditors relied on documents and confirmations. Regulators trusted the company's public status. And Germany wanted to trust its technology champion. When the $1.9 billion could not be verified, the entire structure collapsed. Conclusion: Wirecard's story demonstrates how a respected company can use growth, complexity, and prestige to discourage basic questions. The warning signs existed. Journalists investigated them. Investors questioned them. But the company's reputation often carried more weight than the evidence presented by its critics. Wirecard did not collapse because its industry disappeared. It did not fail because customers suddenly stopped using digital payments. It collapsed because the financial success presented to the public could not withstand independent verification. A company worth approximately $28 billion was destroyed by one simple question: where is the money? The answer was devastating. It probably never existed. If you enjoyed this corporate collapse case study, subscribe to the Case Study Lab for more stories about the decisions, deception, and failures that brought powerful companies down.